What is going on, traders? First video of 2024. Happy New Year, by the way, guys. 9 straight weeks of green after another historic run since the bottom in October 2023. Where are we going to go from here? We did hit all-time highs on the SPY and the QQQ. If you adjust this for dividends, you can see here that we hit all-time highs, surpassing what we saw in January of 2022. If you don't adjust for dividends, then we are slightly below. That's neither here nor there, because what you want to know is, where are we headed from here? Is there a chance that we continue to run up? However, this is where the problem lies. The Fed has a real problem on its hands right now. U.S. non-farm payrolls rose by 216,000 in December versus 170,000 expected. So with jobless claims, with unemployment at historic lows, remaining near historic lows, what can the Fed do here? How could they possibly cut here, right? And if you take a look at Goldman Sachs is projecting that the Fed is going to cut 3 times starting in March, that they're going to have 3 back-to-back rate cuts starting in March. Now, it's no secret that the stock market actually has rallied after a bit of a round of dovish comments by the Fed chairman himself, saying that cuts may come sooner than expected. However, unemployment rate continues to come in much lower than expected. We were expecting 3.8. We came in again at 3.7%, lower than the month prior, right? And I just went over the non-farm payrolls numbers. So it is becoming really tricky to try to tell what the Fed is going to do here. Now, it's crazy to me that in March, right, which is only 2 months away from this recording, there is a 61% likelihood that the Fed is going to cut, that they're going to cut by 25 basis points in March. The most probable scenario, according to Fed Funds futures bettors, is that the Fed actually does 1 rate cut. And there is if you add these 2 numbers up, this is 1 cut, this would be 2 cuts here. But if you add these numbers up, there is almost a 90% betting probability that the Fed actually cuts by May. So one of 2 things could be happening here. Either the market is projecting that something is going to break a lot sooner than expected, or, which this is my suspicion, the market knows the Fed, and the Fed actually has been very accommodative. Aside from, the fastest rate hikes in history, in general, they lean towards the side of, before it gets too bad, injecting more liquidity into the market. This is what we saw after the great financial crisis. This is what we saw in 2018. This is what we saw after the pandemic, right? They're going to lean towards injecting liquidity when possible. And obviously the markets love liquidity, which is why the markets continue a historic bull run that really started right after the great financial crisis. Obviously, we've had a bear market in 2020. We had a bear market in 2022. But, in general, the type of run that we saw after the great financial crisis was all liquidity fueled. And the type of run that we saw after the pandemic was all liquidity fueled, right? Here was the pandemic. This run is just historic. So I think that what the market is betting on is that the Fed is actually going to cut sooner than expected, meaning sooner than inflation getting to 2%. Right now, inflation is actually at 3.1%, and the Cleveland Fed even projects that inflation is going to come in higher than what was initially thought, during the next CPI, which I think is January 11th, right? They're expecting that December CPI is going to come in much higher than they initially thought, and it's going to be 0.3% month over month. But economists are only projecting a 0.1% month over month growth in inflation, right? Versus 0.3%. So who's going to be right there? I think that if inflation comes back roaring, meaning higher than expected, higher than 3.2% year over year, or higher than 0.1% month over month, then for sure the Fed, in my view, is not going to cut, especially with these historically low unemployment numbers. I just want to pause real quick and tell you that we started Mastermind 4.0 today, actually, as of the time of this recording. Session 1 started today. The first session was on technical analysis. For those of you that are unfamiliar, the mastermind lasts 4 weeks, 8 classes. We have 4 modules: technical analysis, trading A+ setups, option selling, and how to trade futures. Plus, you get access to the Discord for life. So make sure you click that link in the description if you want to apply. And if you are accepted, you will know by email. So make sure that if you want to join, and yes, you can join midway and you can join all future masterminds for the rest of time. So make sure that you click that application below. And if you are accepted, you'll know by email. So back to the analysis. In my view, the Fed is not going to be able to cut in March. I just don't see how they do that. Not with unemployment coming out lower than expected, not with jobless claims coming out at historic lows, right? And certainly not if inflation comes in at 0.3% month over month, the highest that we've seen since May 2023. I want you to take a look the last time we had a very similar rate hiking cycle. This was in 2006. The last time the Fed actually cut, the last time that they hiked in 2006 was June 29, 2006. They did not cut until September 2007. And for those of you that were alive then, know that this is when shit started crumbling. And then we finally hit the official recession in December 2007, right? But September 2007 is when there started really the rumblings in the mortgage-backed securities market really started to pop to the surface, right? So it really took them a year and 3 months, June, July, August, September, a year and 3 months, right? The last rate hike that we had was in July of 2023. And it is now, as of the time of this recording, January 2024, not even a year later. Now, I'm not saying they have to follow this exactly, but historically, the Fed doesn't cut until something starts breaking, right? They're not just going to prematurely cut unless, as Goldman Sachs and some other banks are projecting, that the Fed is going to just opt for injecting liquidity into the market. I haven't seen really any evidence of that for this recent rate hiking cycle. Yes, the Fed has done that previously, but not for this rate hiking cycle. Because if I take a look at the Fed's balance sheet, for instance, you could see that the Fed actually, in a very rare instance, is actually keeping their word here. And the balance sheet went from 9 trillion to now 7.6 trillion. And they just keep rolling this off. They haven't added any more assets to the balance sheet. Now, where is the market going from here? Luckily, we have some data points to help us out since we are in uncharted territory. First of all, I want you guys to see something, right? There is this misnomer. It's really part of gambler's fallacy and flawed human psychology that something that went up must come down, right? What goes up must come down. Well, take a look at what happens to the S&P 500 performance after an 8-week win streak. And let me remind you that we had a 9-week win streak, right? Do you think that the market is more liable to go down or go up? Look at this. 72% of the time, the market is up 1 month after, 3 months after, 6 months after, and almost 89% of the time it's up 12 months after. This is insane. Average performance 1 month after the streak is 1.1%. 2 months is 2.7. 6 months is 2.8. 12 months is 8.9. That is the average performance after an 8-week win streak. Now, remember that it's an election year. Let's look at what happened to the S&P 500 since 1928 during election years. Election years have actually been some of the best performing years for the S&P 500. It recorded positive returns 83% of the time of the 24 election years since 1928. Now, here's what's freaking interesting. Only 2 years, and really, I'm going to say 3 years, even though in 2020 we bounced back, right? These were all presidential election years during which recessions took place. 2000, 2008, and 2020. Right? Now, 2020 shows positive because if you guys remember, the pandemic bottom didn't last long. And from March, really until January 2022, we just roared straight up. So election years are generally amazing, except for the times that we actually have a recession. So this is very interesting because if most people are forecasting a recession for 2024, then it will likely follow the pattern of having a negative year, right? You're not going to have a recession and have a, positive year unless we see something like we saw in 2020, but that's highly unlikely, right? Now, what I do think will happen is I do think that the market will continue rallying. And if the Fed prematurely cuts, like Goldman Sachs is expecting the Fed to do, right? It's expecting the Fed to cut 3 times starting in March. If that happens, I agree that the market will just continue rallying and, until something actually breaks. But if the Fed already cuts 3 times prematurely, then something is not going to break. However, if the Fed actually waits until, as it usually does, until something breaks or until inflation gets to 2%, then I think that we are actually going to see a recession. The market will likely still continue higher, in my view, until that recession happens. Now, the extent of the recession, I'm not even going to attempt to predict that. Nobody can predict the extent, right? Is it going to be shallow? Is it going to be deep? Is it going to be average? Nobody knows. So I think the market will actually continue rallying until unemployment starts ticking up, which looks like it's taking forever, until housing prices, real residential property prices start declining, because this is what you see before every recession, right? Is you see property prices start to decline, and we haven't seen that yet. We just saw a flattening out here. We need to see the yield curve between the 10-year and the 2-year uninvert, right, and go back positive. This is usually something that happens before a recession. The recession's marked here in gray. You tend to see the yield curve turn positive before a recession happens, right? This happened the last 4 times, 1, 2, 3, 4. And remember that earnings are going to occur in January, and towards the end of January, we have mega caps. I personally don't think that they're going to report Q4 2024 as, any sort of major disappointment. And I do think that they are going to be projecting, some slowdown that's already probably likely priced in. I don't think we're going to get a ton of surprises this earnings season. I could be wrong, but that is my view. So I do think that the market will start to continue higher. Now, I don't really have a target just yet, because for me, there are a lot of unknowns. I know you guys like when I give targets. I don't have a solid target just yet, except for the psychological 500 on the SPY. And then on the QQQ, obviously there's a psychological 400, but that is actually pretty close to where we are now. Now, I know you guys are going to ask me, oh, but if you think a recession's coming, why do you think we're going to go higher? Well, because those two things can be true. So we can continue higher here, right? We can even continue past 500. And then when we finally get a recession, we can decline. But we might not even decline to a previous known low, right? We've seen that also time and time again. I think that's where people sometimes get caught up, is that if they think that the market should go down, or they want the market to go down, they don't really take into account that the market can continue rallying before then seeing the conditions that you expect for a decline. But by the time that happens, the market is so high up that it does not decline to one of these previous lows. Now, lastly, I shared with you some analysis from my analysis in the Traveling Trader Academy. For those of you that are in the Academy, you know that I send out my analysis routinely. For those of you that aren't, well, I think actually you're missing out, if I may say so. But what I wanted to share with you was this right here. If you take a look at this chart, take a look at the S&P 500, right? The forward price earnings ratio. Right now, we are at 22, right? This is in 2023. The S&P 500 is at a 22 PE. This is the highest PE coming out of a contraction period. See, when you see a period of contraction, meaning when the PE actually goes down, right? When you see a period of contraction, the next time that the PE goes up, the price earnings ratio for the entire S&P 500, that is called expansion. So every period of back-to-back or back-to-back-to-back contraction periods that we've seen, right, has been followed by a pretty modest expansion. So as you see here, in 1995, after a 3 consecutive contraction period, we actually had an expansion of 12.9% in the S&P 500 price earnings ratio. Same thing, if you take a look At 2006 and 2007, we had a 10% expansion. If you take a look at 2011, 2012, we had a 13% expansion. Now, if you take a look at 2023, we have a 13% expansion, but the PE is at 22. Now, this isn't the highest PE. We did hit the highest PE in 2020 of 30.7. But what I'm saying is this is the highest PE coming out of a consecutive contraction period. And the reason that that's important is because you don't give yourself any sort of leeway. After a contraction, right, you have to start modestly, like in the teens, because then that gives you a chance to have multiple expansion periods. But if you are already starting out at 22, which is one of the highest PEs ever, then that doesn't give a lot of runway for growth. Now, with that said, there might not be a ton of opportunity left in the stock market to invest for value, right? But there are some plays that I have my eye out on that I am sending out in the Discord and I'm continuing to do analysis on. But I do think small caps can actually break out here. So the Russell 2000, I think this can finally be the time that it actually starts breaking out. Obviously, things like tech to me are overextended, and there's little value in buying tech here, in my opinion, if you didn't buy it already. There are a couple of stocks like Unity Software, like SoFi. I'm looking at levels on these as well. I'm looking for plays in these stocks here. So there are a few stocks where I think you can actually pick opportunities. But I don't think if you didn't do your investing before, like when I put out the 410 target on the S&P 500 back in, if you see here, October 25th, I said 410 was my target on the S&P 500. If you take a look at the S&P 500 back on October 25th, it was basically right here, right? 2 more days and we actually hit 410 and we hit the bottom on the S&P 500, and that's where we rocketed from. So if you missed that in the Discord, then in my view, I think it's too late to buy optimally here for mega cap tech, for some of the large indices. You know, you could nibble dollar cost average on these pullbacks here, these 3 to 5% pullbacks, but it's really hard to find value. But there are certain things that I think where you can find value. It's just not in the broader mega caps or the broader indices, in my opinion. All right, make sure you put your name on the mastermind waitlist to join. We have a session coming up on Wednesday, January 10th. As of the time of this recording, if you're approved, you get lifetime access to the Discord. You'll never have to pay anything again. Otherwise, feel free to join the monthly Discord where you will get access to the analysis and the plays. You just won't get access to the mastermind live sessions. I am also planning on going live regularly, doing live trading sessions pre-market on YouTube, Twitch, Facebook, Instagram, and X. So make sure that you follow me on any or all of those platforms, because we will be doing multi-streaming, regular multi-streaming for 2024. This is something that you guys asked for, so I'm happy to oblige. Leave a thumbs up. Let me know in the comment section where you think the market is going to go. The Fed definitely has a problem on their hands because they will not be able to contain this very low unemployment rate, especially if inflation is ticking back up higher than expected. So subscribe to the channel, hit that notification bell. Stay safe out there, traders. Peace.